Hey, Adam Hooksema here from ProjectionHub, and in this video I'm going to be answering the question, what is SDE, Seller's Discretionary Earnings, and why is it probably the most important number that's going to determine the value of your business? So if you're thinking about selling your business, or maybe even just thinking about selling your business at some point in the future, you want to understand SDE, you want to know how it's calculated, and you also want to know some nuances about it that I'm going to go through in this video, because the value is not just based on your seller's discretionary earnings. There's some other considerations that need to be considered, especially if your buyer is potentially using an SBA loan to buy the business. So that's what I'm going to walk through in this video. First, just a little bit of my background. I was an SBA lender myself for 12 years, closed about 1,500 SBA loans. And now what we do here at ProjectionHub is help buyers who are looking to buy a business and need an SBA loan to do that. We also help sellers who are thinking about selling their business and want to prepare well for selling to an SBA buyer, right? Somebody using an SBA loan to buy the business. So I'm kind of using that SBA experience to help both buyers and sellers prepare for that transaction and really understand how the SBA is going to look at a deal. So with that, let me go ahead and dive into this SDE question. So what I've done is I pulled together an example here from a client. This was a contractor who was doing residential remodeling work. So what we do is pull together the historical tax returns for the last 3 years. And this is what the lender's going to do, right? So they're going to spread the financials. And so what that means, they'll get the historical financials into a spreadsheet like this. They'll get all your expenses, right? And they're going to come up with, so this might be what the tax returns say the net income is. But that doesn't tell the full story, because there's what's considered add backs, or what's called add backs. And add backs are going to be different based on your specific situation as a seller, but common add backs would be owner's compensation or officer compensation. Now, an important thing I want to point out here is that you can only add officer compensation back if it is sitting up here in an expense, right? And so we're going to look for officer compensation in this example. So right here, compensation of officers. And so, we can, if it is in the expense, then we can add it back. What happens a lot of times is sellers will say, they'll take owner's draws, right? And so they'll draw $100,000 as an owner draw, but it's not an expense up here in the tax return. And so really what that means, if you're taking an owner draw of $100,000, that's really reducing your net income. That's coming out of your net income. So you can't add it back. The only way you can add back that owner's compensation is if it is included as an expense up here in the expense line item. So that's one key thing to note. And then same thing with other expenses. So anything that is included as an expense up there that, like personal life insurance for the owner, personal vehicle use, personal expenses, maybe sometimes you'll see like their personal cell phones or health insurance. Sometimes you might see some travel in there or some meals and entertainment that maybe they'll claim as add backs. A rent adjustment in this case. So basically this is saying, hey, we paid rent to ourselves and maybe we paid over market, so we're going to adjust that. So ultimately here we come up with what's called the seller's discretionary earnings. You can also add back interest and depreciation typically. And the way a lot of times you'll see a business broker value the business is on a multiple of SDE. So a lot of times, if you have a pretty steady business, like the cash flow or the SDE has been, quite similar year over year, then what you'll probably see is taking a 3-year average, take the last 3 years as an average, and then apply an industry multiple to that. And that gives you your valuation. So the 3-year average SDE times the industry multiple gives you a valuation. Now, where do you find a reasonable valuation? So I usually go to BizBuySell, just at a simple high level. You can go to BizBuySell. It's a listing site for selling your business. And you'll see this, if you look for their industry valuation multiple. You can Google this. You'll see different industries, and they'll provide both a revenue multiple and a typical earnings multiple. So you want to look at the earnings multiple. SDE and earnings are basically synonymous here, and find the industry that is most closely aligned with yours. And so we kind of said, well, there's not necessarily a particular one that they fit into, but they're somewhere in this building and construction. So we took a 2.5 multiple, which is around where a lot of these were, to come up with that. Now, that's a way to value a business based on SDE. Now, I want to help you also understand how the SBA lender is going to look at this and how that plays into things, and sometimes how that can actually impact what the value is going to be, really having the SBA drive it versus a multiple of SDE. So right here, you're going to see this debt service coverage ratio, so DSCR number here. And so what is that? Debt service coverage ratio is determining how many times can you pay your debt service, your proposed debt service. So if we have $630,000 of cash flow here, and based on our purchase price, our proposed purchase price, and our loan amount, our proposed annual debt service is $222,000. So 630 divided by 222 is 2.84. That means you have $2.84 of cash flow available for every dollar of debt service. That's a really strong place to be. SBA lenders are going to require you to be typically 1.25 or above, meaning you have $1.25 of cash flow for every dollar of debt service. And so, you can play around with this. So let's say in this business, well, maybe we could sell this for $3 million, or we could get an SBA loan for $3 million. What would that look like instead of $2 million? When we look at that, okay, our DSCR is still 1.89. So from a debt service coverage ratio perspective, this business looks like, at least based on what we have in here right now, looks like it could be valued at a much higher multiple or higher valuation based on the amount of debt that it could service. But we're going to talk about some nuances here. So I left this intentionally blank. And let's say, so there's no salary in here for the buyer right now. Well, in this situation, there were actually two owners, so two officers, two owners, and it wasn't one person making $250. It was actually two people working really hard in the business, and they were each making, $125 basically, plus they were making the profit, right? But you're going to have to, as the buyer, you're going to have to replace two owners who are working full-time, probably more than full-time in the business, right? So you're not going to do that for nothing, right? And so in this scenario, the buyer is if they're going to work in the business, and if they're just one person, they're going to need to take a salary. The lender's going to make them take some sort of salary, most likely. And they're also probably going to need to either bring on another business partner who takes a salary, or they're going to have to hire somebody to replace the current owners who are doing all of that work, right? So in this situation, it might be that, maybe the buyer and the person that they're going to hire each are going to make $125,000. So you might actually have a negative add back. You might have to back that $250,000 out. So here's a question. Actually, what I should probably do here is bring this number down here, because the reality is, when you as the seller, when you calculate your seller's discretionary earnings, it is true that SDE is $626,000, right? But once you take into consideration the negative add back from replacing those owners, this is the true amount that's available, that's cash flow available for debt service, right? Because it's great that we've got SDE of 626, but really we only have 380,000 available to make loan payments. So now you can see what happens. So before, we had plenty of room on our debt service coverage ratio. It was well above the 1.25 minimum, but now we're at 1.14, which is probably below where a lender is going to be comfortable. And so now what you're going to see is that just because SDE might allow you to have a certain valuation, ultimately the SBA loan is going to be the thing that, if the buyer's using SBA, that's going to be what drives a limit on how much they can borrow. So we're going to come back here and say, okay, well, let's go back to maybe $2,250,000. And actually, you know what? In this case, we had a 300-month term in there, which if you're not buying the real estate, which most SBA loans for acquisitions are going to be on a 10-year term. So let's see what that looks like. So that really actually, once I change it from a 25-year term to a 10-year term, that made a world of difference. So our debt service coverage ratio is 1.05. We're going to have to continue to bring this down. So let's see what a $1,750,000 deal looks like. All right, so now we're at 1.36. So that probably ends up, working out. You probably find a lender willing to lend, $1,750,000 on a deal like this. And what that ends up getting you at. So if you're at 1.75 on the SBA, your SDE multiple is right around there too, 1.6 million. So let's just say you were trying to make the case that, hey, we want to be at a higher multiple. We think we deserve to be at a 3.5 multiple. So you come in here and you do 3.5 multiple. You say, okay, we found some data that we think we should be at a 3.5 multiple. Okay, our adjusted valuation is 2.2 million. Well, doesn't really matter. You might want it to be 2.2 million, but the cash flow tells us, hey, it can only afford a $1.75 million SBA loan on a 10-year term, right? So a lot there, but I wanted to just kind of show you the process of what is a lender doing, how do we look at SDE, but then also how do we actually have to look at estimated cash flow for your particular buyer and in your particular situation. It would be a different situation if this officer compensation was only for one person and you just needed one person to replace them. Maybe you have to have somebody at just $125,000 to replace them. So if we looked at that, now our debt service coverage ratio is higher. It can support, now it can probably support a $2 million loan. So point is, SDE does not tell the whole story. It is an important piece of it, and it does make a difference, but the details of your specific calculation of SDE, your ownership structure, and what the buyer's going to need to make in terms of a salary and to replace you, that all matters in terms of what is actually possible from a SBA loan perspective. So I hope this has been helpful. If you have a deal, if you're thinking about selling your business and just want to run it by me, feel free to reach out. Adam@ProjectionHub.com is my email. You can email me. I'd be happy to look at your situation and just give you some feedback. And I'll happy to do that for free. And if you're a buyer on the buyer side and looking at a deal that you want to buy, happy to review that as well. So really, either way, reach out to me. This is what I love doing. I love reviewing deals and giving feedback on these types of deals. And so, and then we can, if we find a deal that, hey, this is one that looks like it could work, we can help you through the SBA process, walk you through that, and help you through the projections and business plan and all of the aspects that you're going to need in terms of securing an SBA loan to acquire a business. So, all right, hope that's been helpful. Thanks.